In this video, we'll explore about the balance sheet and its structure. In India, the format for the balance sheet is strictly prescribed under Schedule 3 of the Companies Act 2013. On top of that, we have IndAS 1, which mandates a statement of changes in equity. For general industries, there is a standard format we must follow. However, for regulated industries like banking, insurance, and utility companies, they follow separate requirements set by their respective regulators. In this video, we will use the consolidated balance sheet of Bharti Airtel Limited for the financial year ending March 31st, 2019 as our case study. To understand the balance sheet, you first need to understand the criteria for what gets recorded. Think of this as a filter. For an item to be recognized as an asset, it must meet three conditions. First, it must provide future benefits. Second, it must be quantifiable in monetary terms. And third, it must be paid for. This means you cannot record self-generated assets like your own brand name because you haven't paid an external price for it. Once an item passes the filter, we look at the timeline to classify it. If the asset provides benefits within one operating cycle or 1 year, it is a current asset. If the benefit lasts for greater than 1 year, it is a non-current asset. Let us look at non-current assets. The first major category is property, plant, and equipment or PPE. This includes physical items like land, building, machinery, and computers. These are usually valued at historical cost. In our case study, Bharti Airtel reported PPE of rupees 815.2 billion. Then we have Goodwill. This is an intangible asset that arises when a company acquires another business. For example, when Airtel acquired Tigo Rwanda, they paid a consideration of rupees 3,200 crores. However, the net assets fair value was only rupees 2,838 crores. The extra amount paid, which is rupees 362 crores, is recorded as goodwill. Continuing with non-current assets, we have intangible assets. These are assets without physical form but represent legal rights such as copyrights, patents, and acquired brands. Remember, internally developed software can be recognized, but self-generated brands are not. Next is investment in joint ventures. We account for this using the equity method. We start with the initial cost, adjust for our share of profit or loss, and reduce the value by any dividends received. Finally, we have financial assets, which are long-term investments and loans. Debt items are valued at amortized cost, while other assets are valued at fair market value. Now we move to current assets. These are assets expected to be realized within a year. The most common item is inventory, which includes raw material, work in progress, and finished goods. The rule for valuation here is very specific. Inventory must be valued at the lower of cost or market value. Then we have financial assets. This includes cash and cash equivalents like money market funds, bank balances, and receivables, which is the money customers owe the company. Note that receivables are shown net of doubtful debts. There are other types of current assets as well. We have short-term investments, which are valued at fair market value. We also have claims that are likely to be received within 1 year. A special category here is other current assets, specifically prepaid expenses. This represents a difference between benefit in kind versus cash. For example, if you pay for insurance in advance, cash is paid now, but the service or benefit is received over time. Since the benefit will be received within 1 year, it is recorded here. Let us switch to the other side of the balance sheet, which is equity. You can think of equity as a stacked layer. At the bottom, you have share capital, which is the face value of shares. Above that is share premium, which is the excess money collected during an IPO or FPO. Then we have reserves like general or capital reserves. Be careful as some reserves are not available for dividends. At the top, we have retained earnings, which are the undistributed profits. In consolidated statements, you will also see minority interest or non-controlling interest. This represents the share of equity in a subsidiary that belongs to shareholders other than the parent company. Next, we look at non-current liabilities. These are obligations due after 1 year. The biggest component is usually long-term debt, which includes loans and bonds. In our example, Airtel has long-term debt of rupees 872.45 billion. Importantly, the portion of this debt that is due within the next year is stripped out and shown separately as the current portion, which is rupees 71.732 billion here. We also have lease liability. This arises when a company has a right to use an asset. The liability is calculated as the fair value of the lease minus the repaid amount. There are other non-current liabilities to consider. One is deferred revenue, which is an advance receipt. Imagine a customer buys a 6-month pack for rupees 1,200. After 1 month, the company earns rupees 200 as revenue. The remaining 5 months worth rupees 1,000 is a liability because the service is yet to be delivered. We also have derivative instruments which show mark-to-market losses. Finally, we have provisions. These are amounts set aside for specific but unquantified obligations like retirement benefits or legal liabilities. Now we come to current liabilities. These are obligations that must be settled within 1 year. A major item is short-term debt. Although this is borrowed for less than 1 year, companies often use a strategy of rollover or refinance, essentially extending the loan repeatedly. Other obligations in this category include payables to suppliers, short-term provisions, the current portion of long-term liability we discussed earlier, advances from customers, and unpaid or accrued expenses. Since the standard format has limitations, analysts calculate specific balance sheet metrics. The most important is total debt. The balance sheet splits debt across different lines, so we must add them back together. We take long-term debt plus the current portion plus short-term debt plus lease obligations plus accrued interest. This gives us the true picture. For Bharti Airtel, if we sum these up, the total debt comes to rupees 12,87,036 million. Another critical metric is working capital. There are two ways to view this. The accountant's view is simply current assets minus current liabilities. For Airtel, this math results in a negative figure of rupees 601.49 billion. This can be confusing. It is better to take the supply chain view. This looks at the operating cycle or cash to cash cycle. It measures the capital invested to sustain the cycle of buying raw materials, holding inventory, selling on credit, and finally realizing cash. To get a clearer picture of operational health, analysts calculate core working capital. This filters out non-operational items like short-term investments or unrelated debts to assess the real need for bank finance. The formula is inventory plus trade receivables minus trade payables. Let us look at the numbers for Airtel. We take inventory of rupees 884 million plus debtors of rupees 43,006 million and subtract payables of rupees 2,80,031 million. This gives us a core working capital of negative rupees 2,36,141 million. A negative number here suggests the company is funded largely by its suppliers